ask you a question. Is the market going to crash? Now, the quick answer is nobody knows. However, there are clues that will tell you whether or not it is going to crash or not. Now, I can tell you there are 5 indicators right now that will tell you whether or not a crash is going to come. One thing you got to understand is that history and data tells you a story. And if you're not careful, history will repeat itself. Make sure that you stick around for my top 5 indicators, and the last one is going to be the biggest piece of the puzzle. Now, always remember that facts and data should drive your decisions in any kind of business setting, not emotions or feelings. There are several indications that the housing market activity is trending and following what the bubble burst did in 2008. Now, some experts say this is much safer because banks have stronger lending requirements than what they saw in the catastrophic 2008 meltdown, but still, there are trends that are ranging from home prices to construction activity that very much resemble the 2005 and 2006 timeframe. Low mortgage rates and massive demand have powered a supercharged rally for the U.S. housing over the last year. Buyers have snapped up nearly all the available supply of new and previously owned homes amid huge population shifts from cities to suburbs, and what they're now calling Zoom towns, after businesses are actually realizing that their workers can work from anywhere in the country or in the world instead of actually having to come to the standard brick and mortar building. Now, one of the biggest challenges, it's left contractors struggling to meet the new demand with adequate supply. See, that imbalance has since pushed prices skyward, which this has led many people to compare the current market with what we saw just before the infamous 2008 crash. Now, obviously, you're going to get people on both sides saying what they think is going to happen, maybe some of them based on their own benefit for them. For example, experts have been quick to note that while some similarities exist, the latest price surge has more to do with lack of inventory than lax lending standards. So now let's get into the 5 reasons indicating a crash. And remember, it's always the data and numbers telling you the story. First, you have home price index. Now, possibly the most basic indicator of just how much demand has outstripped supply is nationwide price index. The Prices for Housing Data Authority, CoreLogic, has stated that values have soared 11.3% year over year just in March alone, which is more than an accelerated rate from February, which was 10.4%. And it's the fastest rate since 2006. On a month-to-month basis, prices rose 2% from February levels. Some analytic firms see this momentum cooling in the next year, basically because of wearing away of the home affordability, which likely is going to curtail some purchases and accelerate construction, which is shoring up the supplies up ahead. Basically, as long as buyers are motivated because of the historically low mortgage rates, there will be anticipated demand. Number 2, Case-Shiller Index. Home prices in metropolitan areas have gained 12% year over year in February, according to the Case-Shiller Home Price Index, which is the gold standard of headline index of home prices for more than 3 decades. It also concurs that it's the strongest price growth since 2006, and it's edged slightly higher from the prior annual gain of 11.2%. Now, out of 20 cities that were measured, prices rose most in Phoenix, San Diego, and Seattle. Number 3. Selling new versus old houses. Looking at home sales a bit deeper, we're seeing another indication of an unusual phenomenon, which we haven't seen since the previous boom. For the first time since 2005, Americans have spent more on previously owned single-family homes than on new construction, according to the Census Bureau and the National Association of Realtors. What this says is that people are trying to buy anything that's available instead of waiting and hunting down a new property. With supply still under pressure, prices are showing that they're going to continue climbing higher for quite a while. Number 4, home starts. The market demand is at a 15-year high, but so have measures of upcoming supply. Housing starts, which surged nearly 20% in March as contractors are trying to capitalize their best on the need for new home sales. Coincidentally, this is the same rate of starts as its highest since 2006, and it serves as the largest month-over-month gain since 1990. Permits for new residential homes have also increased. Roughly 1.1 million existing homes are currently for sale at the current rate. Those will all be snatched up in just 2 months. With millennials hitting peak buying age and lumber prices are expected to decline, some economists see the rebound in construction paving the way for a more moderate price growth. Number 5, home equity takeout. Because prices of homes have appreciated and have gone up so fast, this is leading to owners taking out equity at the same rate that we have not seen since the mid-2000s. Homeowners refinancing their mortgages have pulled roughly $50 billion in equity out of their homes throughout the fourth quarter of 2020, according to data from Freddie Mac and Urban Institute. Now, I think that's because mortgage rates, while still at historically low levels, have reversed their pandemic-era decline, and as investors brace for the economic recovery to give way to higher borrowing costs. Because of the expected higher interest rates and borrowing costs, it's now making equity takeout the top reason for people to refinance. Although equity takeout on its own is normal, but understand the sharp uptick that we've seen in the last year could be cause for some concern. Some economists have actually criticized the Fed's ultra-accommodative policy for encouraging these risk-taking activities across various markets. Increased equity takeout could present a new issue for homeowners, since a decline in home prices from their sky-high levels could actually cut deeply into their equity positions. Now, right now, equity takeout is sitting at a 2005 level, but it's still well below the 2006 peak level. Yet, with mortgage rates expected to climb over the next few years, takeout refinancing could accelerate a little bit further. So to summarize all this information, it's not to excite you or to deter you. It's just to inform you of the facts. The facts and the data are showing you a lot of similarities to other crashes in the past. Now, if you like this video, please make sure that you comment, like, and subscribe to my channel so you can get more information like this in the future. Thank you very much.